A single 7,000-word report just wiped out more than $100 billion in stock market value in a single day. Not a war, not a pandemic, not even a real event. Just words on a page describing something that hasn't happened yet. And the strangest part, the report itself openly admits it's fiction. In February 2026, a research firm called Citrini Research published something they called a thought experiment. It was written from the perspective of someone living in June 2028, looking backward, describing exactly how artificial intelligence quietly destroyed the modern economy. The very first line of the report reminds you, you're not actually reading this in 2028, you're reading it right now. And yet investors panicked anyway, because even a well-labeled piece of fiction can reveal a genuine fear that was already sitting under the surface, waiting for a reason to come out. The Dow dropped over 800 points in a single day. IBM alone fell nearly 13%. Software and payment companies got hit even harder, all because of a hypothetical story that hadn't happened and might never happen at all. So what did this report actually describe? It called it the intelligence displacement spiral. Here's how it works, step by step. AI models get smart enough to handle real white-collar work, coding, analysis, legal research, financial modeling. Companies quietly start replacing expensive human employees with AI systems instead. At first, this looks like great news for the stock market. Fewer employees means lower costs, which means fatter profit margins. Stock prices go up, investors celebrate, and AI spending increases even more. But every single one of those laid-off employees was also a customer somewhere else. They stopped spending on dinners out, on new cars, on vacations, on almost everything. Consumer spending makes up 70% of the entire American economy. So when enough people lose their paychecks at the same time, that spending simply disappears. Companies see slower sales, panic, and cut even more human jobs to protect their margins, which increases AI investment even further, which accelerates the very job losses causing the problem in the first place. That's the spiral, feeding on itself, faster and faster, quarter after quarter. According to the report's imagined timeline, unemployment reaches just over 10% by 2028. The stock market falls 38% from its highs, and the $13 trillion mortgage market starts to crack, as millions of former white-collar workers can no longer keep up with their house payments. The report doesn't stop at just describing job losses either. It also describes something it calls ghost GDP, companies technically producing more output than ever before, using AI instead of people, but almost none of that new value ever reaching an actual paycheck. Labor's share of the entire economy, the portion of national income that actually goes to workers, supposedly drops from 56% down to just 46% in the scenario. That's not a small shift. That's trillions of dollars moving away from paychecks and toward corporate profit margins instead. The report even names specific companies as examples inside its hypothetical timeline. It imagines a major software company like ServiceNow announcing a 15% workforce cut, calling it a structural efficiency program. It imagines payment companies like American Express, Synchrony, Capital One, and Discover all losing significant value, not because people stopped needing money, but because AI agents start comparing prices and fees automatically and routing around the very systems that used to earn those companies steady profits. Even food delivery apps aren't safe in this scenario. The report imagines AI assistants checking multiple delivery platforms at once just to find the cheapest option every single time, which quietly destroys the brand loyalty that companies like DoorDash spent years building. It's a strange kind of disruption, not one big dramatic collapse, but thousands of small, quiet cracks, all appearing around the same time. Here's what makes this genuinely unsettling. Some of it is already starting to rhyme with real headlines. Just months after the report went viral, Block, the payments company, announced it was cutting close to 40% of its own workforce. Its stock price jumped on the news. Investors cheered the efficiency, which is exactly the disconnect the report warned about. Markets celebrating the very layoffs that could eventually hurt the broader economy. Now, not everyone agrees this nightmare scenario is realistic. Goldman Sachs, for example, is far more measured. They're projecting unemployment drifting up to only about 4.5% by the end of this year. nowhere close to the 10% the report imagines for 2028. Historians point out that new technology has destroyed jobs before, and every single time it eventually created new ones instead. ATMs were supposed to end bank teller jobs. Instead, banks ended up employing more tellers than before. Spreadsheets were supposed to replace accountants entirely. Instead, the accounting industry grew even larger. The optimists call this the same old pattern: creative destruction. Painful for some, but ultimately good for the economy as a whole. Every wave of automation in history eventually created more jobs than it destroyed. Just not always the same jobs and not always for the same people. The pessimists point out one uncomfortable difference this time. Past automation replaced physical labor or repetitive tasks. This wave is aimed directly at thinking itself, the exact skill that white-collar careers were built around. That's exactly why the report singles out coding, legal research, financial analysis, and customer support as the first dominoes. These are jobs built almost entirely around processing information and producing a written or spoken answer, which happens to be exactly what today's AI models are best at. Jobs built around physical presence, hands-on trust, or split-second human judgment in unpredictable situations are, at least for now, much harder to fully replace. But even the report's own co-author admits something feels different this time. The difference isn't just that AI can do the tasks, it's the speed at which it's happening. Elevator operators disappeared gradually over decades, giving society time to adjust. If white-collar disruption instead happens over a handful of years instead of a generation, there may not be enough time for new jobs to appear before the old ones vanish completely. So what does any of this actually mean for you watching this video right now? It means the anxiety you might already feel about AI and your own job isn't irrational, and it isn't something to feel embarrassed about either. It means relying on a single skill set, a single employer, or a single industry is genuinely riskier than it's ever been in modern memory. And it means the businesses and workers who adapt early, instead of waiting to see what happens, will have a real head start. So here's the simplest thing you can actually do about this starting today. Don't try to compete against AI at doing your job faster than it can. Instead, learn to be the person who directs it, reviews it, and catches what it gets wrong. Every single industry will always need people who can judge whether the output is actually correct, valuable, and safe to use. That judgment is exactly the skill that's hardest for any machine to automate away. Start treating your own resume the way a company treats its balance sheet: diversified, not concentrated in one single asset. Learn to work alongside the tools everyone else is scared of, instead of avoiding them out of fear. The workers who get replaced first usually aren't the ones using AI. They're the ones who refused to touch it until it was already too late. Nobody, not Citrini, not Goldman Sachs, not any single economist, actually knows exactly how this unfolds. The report itself admits it's not a prediction. It's a warning about an underexplored risk. But the fact that one hypothetical document can wipe out $100 billion in a single day tells you something important all on its own. The market already believes this future is at least possible, and possible is enough reason to start preparing for it today. If this helped you understand what's actually happening with AI and the economy right now, follow Dollar Den. We break down real financial stories every single week without the confusing jargon, so you always know exactly where you stand.